conversation with James Athey, Marlborough Group.
So James, welcome to One Basis Point. I want to start somewhere personal before we get into markets. You've been in fixed income since Deutsche Asset Management in 2001, and that's 20 plus years. Genuinely brutal periods. Most people in finance often gravitate towards equities. What is it about bonds that pull you in, and what's kept you here?
Sure thing. Yeah. Hi, Chris. Thanks for having me on. It's good to be here. I guess, what I studied, what I enjoyed studying most, at least at school and at university, was economics. And the way that my brain works, the way that I approach problems, the way that I'm wired in terms of thinking very much leans into that notion of kind of big picture thinking, what we would call macro thinking really today. And when I looked at what equity investors were, particularly at the time, and certainly the way in which they had to approach the problem of equity investing, it was more accounting, essentially. It was more about bottom up, stock selection, looking into individual companies, looking at their balance sheets, their cash flow statements, etc., and making investment decisions on that basis. And, fixed income, particularly rates products, particularly government bonds and interest rate products, that was very much about that big picture, that macro problem. So it appealed to me intellectually is why that's the path that I followed.
Spoke about bottoms-up approach. Do you think in today's day and age, it still makes sense given the ridiculous valuations that some of these companies are trading at?
Whether it makes sense or whether it's lucrative, I think are two probably different questions. To me, it absolutely does make sense with some provisos because, it really is a statement of fact that actually, even if lots of equity investors spend all their time looking at individual companies, actually, standard investment theory, standard capital market theory tells you that much of the expected return or the variation of price of a given equity comes from factors other than the individual company. So you have obviously the index itself, so beta as a relationship between an individual stock and the index. And then you have sector performance and country level performance and sort of the performance of higher quality or lower quality companies. And obviously in the modern age, you have lots of factor driven investing. So factors could be things like value and growth and things like momentum. And so you've got all of these factors of performance, which are nothing to do with that individual decision about the quality of a company or the stability of its earnings profile or the rate at which their earnings are growing. So I think it is fundamentally still a viable approach to investing to look at individual companies. But I think in order for that to shine through as the main driver of your performance, you need to understand and probably neutralize all those other risks. So to give you an example, I could do a lot of work on Exxon, the huge US oil company, right? I could do a lot of work on Exxon, specifically look at Exxon's balance sheet, look at its management, look at its sort of recent earnings growth and its recent revenue growth and all of this stuff and make a judgment about how that would change going forward. A war starts in Iran and that shuts off 20% of the supply of oil and the oil price goes up and Exxon's price goes up. That was not something that I assessed or analyzed, and my performance is therefore to a significant degree an accident, a quirk of fate, because actually when I bought Exxon, really, I was buying a significant exposure to oil. So in order to make Exxon shine through as the individual driver of my return, I would have to neutralize my risk of oil. So if you're a benchmark relative investor, you would have to sort of short all the rest of the energy sector and just concentrate your position in Exxon such that your benchmark weight in the energy sector all implemented through a long in the Exxon stock. That way, I have no exposure in net to oil. I just have exposure to Exxon. But I don't think many, even institutional investors, truly construct their portfolio in that way. So I think they end up with a lot of accidental bets, a lot of accidental exposures, which can significantly hurt performance. But I guess probably the answer that you were hinting at, and what's probably more relevant, is in a world of passive investing as the dominant go-to for a lot of investors, and in a world of significant systematic investment style, and I'm going to include a lot of modern hedge funds in that as well, because ultimately these investors make decisions based on technical signals. So price and volatility are the two simplest, two most common and two most powerful drivers of their behavior. If the price goes up, they're more likely to buy that security. If volatility goes down, they're more likely to add risk across their whole portfolio. And on any given day, on a day-to-day basis, they are the dominant investors in most markets. And so the person doing something very different, like looking at individual companies, can find that it takes an awful long time for all of that noise coming from systematic investors or investors who are looking at the investment problem in a very different way, all of that to subside and the quality of their analysis to shine through. So I think there is still a place, but it's very difficult to do that in today's market.
That makes sense. I guess doubling down on my previous question, like these days, what the news is, the stock market just seems to go up. What do you make of it?
Partly because of what I've just said, partly because momentum is now a powerful and inherent force in financial markets, right? You have so many investment styles who are forced to buy a market the more it goes up. You also have a much more powerful retail investor base, particularly in the US. Some of that is discretionary, individuals at home with like a Robinhood account or an Interactive Brokers account, essentially trading. But the lesson that they have learned is that equities always go up, so they buy every dip, and that's a self-fulfilling behavior, right? So the structure of the market really does almost dictate that you will have these kind of powerful bull markets that seem to trend for forever and ever. And so it's impossible to escape that in the short term. That's a dangerous sort of set of behaviors to learn, right? If everybody believes that things will always go up forever, then essentially risk is being mispriced. But that is certainly, a fact of the modern world. Of course, specifically at the moment, we've also got, let's say, a once in a generation technological advancement that is obviously difficult to understand and difficult to price, but we can see in real earnings reporting, in real generation of cash flow and earnings from certain companies within the AI infrastructure, that huge amounts of money are being made. So of course that acts as a huge tailwind. I guess one cautionary note there with respect to sort of big tech and hyperscalers and AI is that another aspect of this seemingly insatiable demand for equities has been stock buybacks. Incredibly profitable companies that have been, until recently, asset light. So they have huge margins. They don't have to invest in a lot of fixed assets, and they benefit from network effects. And that essentially means that the more popular the product that they have, the more popular it becomes. And so you have this powerful generation of earnings, very wide margins, and that's allowed them to earn huge profits and buy back stock with that. And that's been a big tailwind for the stock market. Now, as some of those big tech companies are forced to invest in data center build out, essentially, their free cash flow generation is falling dramatically. They're actually having to borrow to invest. So their ability to buy back stock is declining materially. And that will start to, I think, weigh on the stock market a little bit more. That's not to say it will go down or go down imminently, but certainly one of those big tailwinds that we have been accustomed to is less of a tailwind today and is potentially a
If this bull run do you think is sustainable?
Well, it's not particularly fashionable necessarily to take a step back and think in terms of the really big picture and think historically. It's been said a million times that the most dangerous words in investing are "this time it's different." And at the peak of every other major bubble, there has been something real that's going on that has validity, but is an idea taken too far and over extrapolated, and such that sentiment at the very peak of the bubble is that this is a game changer. Irving Fisher, the economist in the 20s, uttered the famous words that stocks have reached a permanently high plateau. And of course, he called the top of the sort of 1929 bubble almost to the day, and that ushered in the Great Depression. Similarly, things were being said in 1999 and 2000 about the role that the internet would play in society. And to a significant degree, it turned out to be true, but that doesn't mean that stock valuations across the board were justified. So I think the same is going to be true here. No matter how successful AI is as a technology, no matter how much it changes the economy for the better or for the worse, I still believe it's very difficult to extrapolate the sort of earnings growth that we see today far into the future. And I still think there are significant questions about the extent to which AI as a technology is monetizable. It already is starting to display some of the qualities of a commodity, and a commodity doesn't tend to generate excess returns and profits because it's, broadly speaking, widely available and available at very low marginal cost. So there's two big questions there. There's a difference between AI as a powerful technology and as AI as something that's generating the sort of returns that would justify stock markets where they are. So, if you look at CAPE as a sort of long-term valuation measure, if you look at price earnings ratios, if you look at the stock market as a proportion of GDP, if you look at the stock market as in relation to whole economy profits, which is a series reported by the Bureau of Economic Analysis, those divergences are historically high. On all of those measures, it's hard to really believe that the stock market can continue powering on from here. Just a blind look at history says if you buy the US equity market with its prevailing valuation today, your expected return over the next 10 years is somewhere around zero. And nobody wants to be told that. And that doesn't mean that the return over the next 3 days, 3 weeks, 3 months is going to be zero or negative. But obviously, over the long term, valuation is a powerful driver of expected return. So, as always with these things, what we used to say at my former employer was we look for vulnerabilities, not triggers. It's very hard to identify in advance when and why a big trend will reverse. But when you look back historically, you can kind of easily see why it might reverse because there is an inherent vulnerability. And I think that's the situation we face today, is that there's valid reason for stocks to have performed well. That's not the same as saying that you should be very exposed to what is an incredibly expensive equity market.
Makes sense. Taking a step back, you've come from Aberdeen running European and global government bond funds, and now you're at Marlborough running an unconstrained global mandate. People who don't know the difference, what actually changes when you go from a benchmark constrained fund to an unconstrained one, it changes the way you think about risk.
Yeah, it's a really good question. I mean, ultimately, it shouldn't change the way that you think about risk. It should really manifest just in the construction of the portfolio and the constraints around the extent and the magnitude of your sort of position taking. So in both cases, these were long only mandates. So not truly sort of unconstrained in the sense like hedge funds might be able to short instruments, borrow them and then sell them into the market, hoping to profit from a decline in prices. In that type of product, you can have really neutral exposure to the market in question. Generally, the mandates that we have within what we'd call real money, so more traditional mutual funds and pension funds and sovereign wealth funds and what have you, these tend to be long only mandates. So you can buy an asset or not buy an asset, but you can't short an asset. So in that respect, they're similar. But for me, thinking about risk is identical across the two, which is to say I'm always thinking about probability and what if. I'm always thinking about trying to understand what the potential outcomes can be, how likely those outcomes are, how assets should behave under each of those potential future states of the world, and try and have a portfolio which is tilted such that the odds are in my favor, but with a diversification such that it's not entirely reliant on a particular outcome. That's always how we think about assessing sort of the macro environment and how we think about implementing risk. In an unconstrained fund, of course, you just either don't have a benchmark or you can really deviate significantly from it. In a more constrained vehicle, your exposures will tend to be closer to the benchmark. And just on that last point, and I think this is important, part of the reason for that is if I'm managing money for an institutional client, that might be, let's say that's a pension fund. A pension fund obviously has a huge amount of assets, and it's likely to outsource the management of those assets to asset managers. And not one necessarily, but lots of different ones. So it will split its pot of money into separate mandates, and it'll have a mandate for global governments and a mandate for global credit and a mandate for high yield and a mandate for EMD, for European equities, UK equities, all across the asset spectrum. And so they need you in order for their funds to remain as diversified as they want it to be at the aggregate level. They need you to stay in your lane, so to speak. They've given you a global government mandate because they want you to perform like global governments do, because your sort of subset of their overall pot is playing a part in a wider asset allocation. If they allowed you the freedom to veer into other lanes, then suddenly you're sort of treading on the toes of the other pots of money, the other mandates, and they may end up with something which is less diversified than they want it to be. So there's a reason why at that kind of institutional level of asset management, you tend to find that your mandates will be more restricted against a given index, a given benchmark. Whereas in a pooled fund or something which is trying to perform throughout the cycle potentially, then maybe there's more freedom to be unconstrained and to deviate a bit more significantly from an underlying benchmark, or indeed to have cash as a benchmark and just outperform.
Quite interesting, because I never really thought about it from that perspective. And now that you mention it, I'm thinking it in my mind that at an aggregate level, large pension fund, it actually makes a lot of sense to have constrained funds. Given where we are right now, do you think ever get to pre-pandemic yield levels?
Could we? Yes. Like, the short answer is yes. Like, it feels so incredibly unlikely as we sit here now for obvious reasons, because, for the entire post-financial crisis period, inflation was very low. And actually, the post-crisis period came at the end of a really, really long secular bull market for bonds. If you go back to and I guess in that respect, there is a certain amount of historical kind of analog here, because the start of that long bond bull market was the end of the 1970s, and the 1970s was characterized by basically two things: energy and oil shocks and massive inflation. And what we've just gone through since COVID is oil and energy shocks and massive inflation. So you had high interest rates, high bond yields, high inflation. And what you needed was that inflation that inflation devil to be dealt with. And you got that through a combination of less irresponsible government policy, so a tightening of fiscal policy, and more responsible monetary policy, i.e. genuinely hiking rates sufficiently, withdrawing liquidity sufficiently to deal with inflation. And once the inflation problem was resolved, you had this long decline in inflation and then stabilization of inflation, and that brought with it interest rates. So given the starting point today is high inflation and high yields, it's easy to sort of think this is where we'll be forever. But of course, the last time we had this problem and it looked like inflation would be around as far into the future as you could go, actually that turned out to be a once in a generation time to buy bonds. So it's possible. Where this is slightly different, and of course no historical analog is perfect, but where this is slightly different is there are things going on a secular basis under the hood globally which do look like they're going to make it difficult for inflation to sort of fall to the extent that it has done historically. Globalization versus deglobalization is a well-trodden topic, but genuinely I think there are reasons to think that can keep prices more elevated. That's not the same as saying inflation is elevated, by the way. Inflation is a rate of change and prices are a level. So high prices could still be zero inflation. But it's still a risk that might keep sort of inflation elevated. And government policy, I think, is the bigger concern, really. It essentially took damn near crisis conditions, damn near crisis conditions in the late 70s to get governments to behave more responsibly. Unfortunately, we've learned some bad lessons in the last 15 years, and that is not allowing crises to lead to markets exerting discipline. central banks have become far more activist. They step in, soothe worries, soothe conditions, provide liquidity, such that actually governments have been allowed to behave badly for far too long, run persistent and pro-cyclical budget deficits, build up debt as a stock and as a proportion relative to the size of their economy to quite worrying levels. And there aren't really many countries that have got political parties with significant support that want to do anything about it. And so that, I think there are conditions where we could see rates go back down to 0 to, below 1%. But right now it does seem quite unlikely. I think what it would take to get us there really would be a proper recession. And I fear, given the state of financial markets and economies at the moment, if we got a proper recession, we'd probably have what looked like a crisis along with it. In those conditions, I think you can see rates falling dramatically.
Another big difference, 80s or 70s compared to now, is more unstable or unreliable US administration. How foreign policy is just changing every day. You think it is still possible in these circumstances for yields to come down?
I do, because I generally don't choose to think about credit risk when it comes to government bonds issued in local currency. Historically speaking, governments don't default on their local currency obligations. The exception is Russia in 1998. That was a political choice as opposed to an economic imperative. If we put that aside, defaults tend to be hard currency phenomenon. So emerging market countries, Argentina is obviously the poster child, but there are plenty of others. They borrow in US dollars. And that means they're vulnerable to exchange rate risk because they don't own a dollar printing press. And so they can be forced to default purely because of exchange rate risk, not least because of bad domestic economic management. So even if the US has become an unreliable partner geopolitically, even if we're seeing a sort of fracturing of some of the status quo ante in terms of the world order, I don't think that is necessarily an upward pressure on US Treasury yields or gilt yields. It can be in the short term, but not on a medium term or secular basis. In the medium term, the ultimate drivers of bond yields is going to continue to be inflation, growth, and the behavior of authorities, so fiscal policy and monetary policy.
To follow up, there has been a lot of divestiture from US Treasuries from countries like India, China, even the Norwegian Wealth Fund, for instance. Last month was the first time where dealers were forced to buy more bonds at auctions. See that as a trend that is going to continue? I know you sort of spoke about this, but...
Yeah, so, if you look at China, they've obviously been disinvesting from treasuries for a long time. And that predates Donald Trump becoming president after the 2016 election. I think that's been a trend since around 2014. China tends to be a very long-term thinker, and I think that they very early recognized that their sort of codependent relationship with the US was a risk and a vulnerability to them that they didn't want to persist. Furthermore, they recognized that US monetary policy, which we know has a powerful influence globally, was not something that they wanted to be reliant on. Other countries, of course, have been disinvesting away from treasuries. The Norges Bank, I think, is probably, or the Norges Fund, sorry, it's probably slightly more in relation to what's been going on from, what's been coming out of the White House recently. I think in other cases, it's more of a diversification trade. And actually what we've seen significantly in many countries is a shift into gold. And that, which I believe, I have a strong view about the role that gold should be playing at the moment. I think that's a very powerful dynamic, but that relates more, again, in my opinion, to the combination of fiscal and monetary policy rather than foreign policy. The one foreign policy example, and again, this is not a Donald Trump phenomenon, this is a phenomenon under successive presidents in recent years. The one geopolitical foreign policy that I do think is the most clear and present danger to US dollar, US assets is the use of sanctions. And then particularly what we saw in 2022, obfuscation of Russian assets. Because if your reserve balances are essentially a rainy day fund, then the notion that they could be confiscated if you behave in a way which is contrary to the wishes of the current administration, whoever that may be, that is a risk that no reserve manager wants to be taking in significant size. So the combination of the US weaponizing the US dollar, which is a big risk, but also running these irresponsible fiscal and monetary policies, that combination, yeah, you better believe that is undermining the role that US dollar and US assets play in the international system. But in my opinion, and empirically it's true in many cases, the right trade is to buy more gold, because gold is the one asset that's no one else's liability. It cannot be printed, it cannot be fudged, it cannot be fiddled with. There is a reason that gold has performed that role for thousands of.
Another interesting trend that I see with the yield curve, the Feds have been holding rates steady. Long yields just keep on rising. The curve is steepening. So is that the bond market telling us something that central banks aren't willing to say publicly about inflation and fiscal sustainability?
Yeah, I mean, obviously the initial response post the war in Iran starting was a flattening of the yield curve. So actually what happened then was the front end was aggressively repriced as we moved from expecting cuts to fearing hikes. I'm not sure outside of the ECB, I'm not sure anybody expects, or I'm not sure consensus expects hikes from the Fed and the Bank of England particularly, but certainly the distribution of probabilities shifted dramatically. So front ends rose in yield and that flattened the yield curve. But yes, broadly speaking, there is quite a significant disconnect between the very front end and the very back end. I think it's all of the above. I think it is all of these things that we've talked about playing into just a lack of demand for longer duration assets. People are concerned that inflation will continue to be a problem for cyclical reasons, for Iran reasons, and for secular reasons, for structural reasons. Again, that we've talked about deglobalization being a big one, geopolitical uncertainty. Those things are making people cautious about owning the really long end of yield curves, kind of understandably. The stability or the sustainability of the US fiscal position. And again, the US is not alone. Everybody's in a bad place to some degree. All of those concerns, I think, continue to pressure long end yields higher. Again, as an investor, you have to look at that and ask yourself at a certain point whether that has created value, whether actually we are now overpricing some of those risks and concerns. You know, a point I'll make here about bonds, and this is something that's dramatically different between government bonds and equities, is that the feedback relationship between a government bond and its drivers, so the factors that affect its yield, is a negative feedback. So what I mean by that is rising yields would tend to slow the economy. A slowing economy would tend to slow inflation. Slow growth and slow inflation leads to falling yields. So rising yields leads to falling yields. So there is this kind of inherent mechanism of correction that exists, a negative feedback. In equities, you have the opposite. In equities, a rising equity market makes consumers feel wealthier. If they feel wealthier, they spend more money. A rising economy means rising equities. So that's why you have such different in behavior between bond yields and equities over the cycle, is because equities are a self-fulfilling prophecy. So if you have a 10-year cycle, they go up for 9, and then they undo all of that in 1 year, up the escalator, down the elevator. Whereas bonds tend to be more range bound, because every time yields go up, it slows the economy and yields come down. So in that respect, when you look at some of these longer dated yields at the moment, as a bond investor, you are starting to think, well, this is likely to hurt the equity market because it's a higher discount rate. So the present value of your discounted future earnings goes down. So equity multiples should go down. Plus, it should slow the economy. And plus, ultimately, it should act to discipline governments. We've seen that dramatically in the UK in 2022. A rather irresponsible mini budget from the Prime Minister of the time. The gilt market essentially imploded. And within 45 days, she was out of a job. The market bared its teeth, and the government had to cow. And this always takes you back to the sort of James Carville quote from the Bill Clinton election campaign in the early 90s, where he said, if he was going to be reincarnated, he'd want to not come back as a 400 hitter in baseball or the Pope, he'd want to come back as the bond market because you can intimidate everybody. And that is still to some degree true today. The reason it's less true is because central banks have built these massive balance sheets. They've taken duration out of the system. They've essentially interfered with the pricing mechanism and the mechanism where investors can discipline governments, what Ed Yardeni called bond vigilantes. Of course, they've been selling down their balance sheets, and so we've seen a bit more discipline in markets in recent years. And ultimately, I still believe that in the end, the bond market would win. Any government that truly tries to take on the bond market is going to lose. It may happen quickly, it may happen more slowly, but in the end, the bond investors will have their way.
If central banks just keep on intervening again and again.
Well, because then the outlet is the currency. So then what you see, and Japan, I guess, is a good example of that today. Japan desperately wants a policy mix which doesn't make sense, and the outlet is the yen. So the yen keeps weakening. So they're trying to intervene, and they've been intervening over the last week, but really those interventions are a brief interruption of this constant trend depreciation of the yen. So the yen is the cheapest currency worldwide by a country mile when you look at it on a sort of real and effective exchange rate basis. But to some degree, there are good reasons for that. Monetary policy has been very slow to try and normalize rates. Fiscally, the government still wants to expand. It still wants to spend more than it's taking in revenue, even though inflation has largely been above target. So that mix is not good for bond investors. So we've seen bond yields rising, and the outlet really continues to be the currency. At a certain point, that becomes untenable. And again, the government, the central bank, would have a choice of changing their policy or getting into a really bad emerging market looking situation where bonds and the currency are selling off together. And that can get very bad very quickly. Again, the UK in 2022 is a recent example where that happened.
This mechanism is also because of the way central banks are structured, where policies often work in a lag. Central banks are always going to be behind the curve, which is why bond market traders tend to prevail. Like, am I making the right?
Yeah, I mean, it's inevitable that central bank policy, operates with a lag. That's a kind of economic reality. Let's be honest. There are some that believe that's less true. There are some that believe more in the kind of financial conditions transmission of monetary policy. That actually policy has its effect near instantly because asset prices adjust to the change in policy quickly, and it's asset prices through which the main transmission into the economy is. I don't really believe that. I think it's more true for some economies. The US probably, it's a very market-driven economy. Lots of corporates borrow via financial capital markets rather than through bank lending. It's less true in Europe and the UK. But even for the US, I don't truly believe it's true. I truly don't believe it's instant. But that's inherent. There's nothing really that we or central banks can do about that. I think where they tend to make errors and make things, in my opinion, worse with specific respect to that problem is they say things like data dependent. And the problem you have is that the best data that we have today is really only telling us something vaguely accurate about some period in the past. And the decision the central banker makes today is going to affect the economy over some unknowable period, 6 to 18 months into the future. So if you look at data to drive your decisions about policy changes, then you are locking in that inherent time inconsistency. The notion of another one which has become very popular, central banks talk about waiting to be sure, and that is just philosophically false, because if their policy works always, let's say 12 months into the future, as each day passes, we do not learn more about a fixed point in time. We learn the same amount about a rolling 12-month period into the future. So it's an error of judgment, an error of philosophy, and a fallacy to believe that you can learn more about your rolling policy horizon. So I just think the way central banks think is utterly flawed. Unfortunately, to do it right, they would have to rely on forecasts, and they're not very good at forecasts because they're very difficult, largely. Also because the economic models they use are terrible and should be thrown away. I think what's going to be a really interesting experiment is what happens when Kevin Walsh is is installed as governor of the Federal Reserve, because, I find myself agreeing strongly with a lot of the things he says, and he clearly wants to shift the way that the Fed solves the problems that is facing. And I think it could be very positive in the long term, but it could be destabilizing in the short term. But definitely, he seems to want to instill judgment as opposed to data dependency for exactly the reason that I've just described. So there's an inherent time inconsistency in central banking. I'm not sure that time inconsistency has made the sort of outcomes worse, but the way in which central banks have tried to address it, I think, is flawed, and that has definitely made things worse. Again, 2022 is the perfect example. It's one thing to think that inflation was going to be transitory, but there's surely a huge amount of uncertainty around that statement. The right policy choice would be to be somewhere near neutral so that you were never really wrong. You wouldn't be really right and you wouldn't be really wrong. A risk management approach. What central banks did is they said very early, hey, it's transitory. It's a one-off supply shock. Nothing we can do about it. But they had rates at 0.5% and they were still doing QE. So in a world of uncertainty where inflation is rising, but you think it probably comes down, you've still got your foot fully to the floor in terms of the gas pedal, at a time where the government had its foot fully to the floor on the gas pedal with massive fiscal stimulus. In my mind, that is the definition of insanity, to have such an extreme policy at a time of obviously rising inflation in the now and potentially rising inflation in the future. They should have been much more humble and therefore much more neutral in their policy setting. And then if it turned out inflation was transitory, okay, so maybe you can cut rates again a bit afterwards. If it turns out it wasn't, you don't have as far to go to hike rates to get them where they need to be. So I think there's lots of practical problems in how central banks actually go about their business, which are unrelated to the theoretical problem of time inconsistency.
Spoke about Kevin Walsh being a good governor, but I feel he's sort of being dealt a short hand. Because if he tries to reduce interest rates, people would start questioning the independence of the Federal Reserve. What do you think his approach would be once he's sworn in?
Well, I think you're right. I think he has been dealt a difficult hand, and I think he's been labelled as a patsy even before he's been given a chance, which I think is unfair and I think unnecessary. I would point out that Elizabeth Warren, who's obviously been very critical and voted against him in the Senate hearing, has a problem that he wants to sort of force the Fed to cut rates at a time where that's inappropriate and there's political interference. She wrote an open letter to Jerome Powell in the aftermath of COVID telling him to cut rates. She is guilty personally of exactly the thing that she's accusing Kevin of when he hasn't even taken his seat. So that sort of hypocrisy, I don't think, is helping the discussion or the debate. The other thing to say is that we're still talking about a committee. This is not Kevin Walsh, the dictator of the Fed. This is Kevin Walsh, a slightly more influential role within a committee of independent thinkers and people who have their own thoughts and ideas and notions. So his ability to just go in there and demand lower rates is very low indeed, and I don't think he will do that. So I think it's evolution, not revolution. I'm not expecting big changes in the here and now. I don't expect rates to be cut in this type of scenario where the Iran war is still ongoing. We don't even have an end to that, let alone have any sort of clarity about how long the impacts through energy markets are going to last. So I think there's a lot of hysteria about the challenge to Fed independence. There are two realities here. One, the Fed is not independent and never has been, nor should it be. It should be democratically accountable. It should be transparent. Everybody on there has been to some degree politically elected. So of course that means it's not truly independent. Its monetary policy decisions should be independent, and I think they are. Second is presidents throughout time have tried to influence Fed chairs to lower rates, right? Again, some have been more physically violent than others, but they've all, to some degree, got angry if central bankers are hiking rates when they don't want them to. So that isn't that unusual. It's just obviously the way that President Trump goes about it is incredibly unusual, and that's, I think, what gets people most upset. But I would draw a distinction between the crudeness of his approach and its effectiveness. I don't think it's effective at all. Quite the opposite. I think in many cases, other members of the Federal Open Market Committee actually probably become more inclined to not cut rates in order to ensure that Donald Trump doesn't get what he wants.
We are seeing cracks. I think this time around, dissent was at the highest it's ever been in a few years.
Yeah, a lot of years. Yeah, 4 dissents in one meeting we haven't had since the 90s, I think. So obviously Stephen Mirren kind of doesn't count. At the moment, there are no spare governor seats for Walsh to take his role because Powell is staying. So we presume that Stephen Mirren will have to step aside for Walsh to take that seat. And he's voted for a cut at every meeting. And clearly he is a sort of direct mouthpiece of the president. So let's ignore his vote for what it is, a kind of absolute protest. I thought the other votes with respect to the language in the statement, I felt that was a bit weak because there's no explicit easing bias. Their interpretation of a specific word in English leads them to believe that's suggesting an easing bias in a way that I don't think investors would read that statement in the same way. So I sort of felt, again, to some degree, there are people on the committee that are going out of their way to show, no, we will not be cowed. And again, I think that speaks to the fact that to a significant degree, the president is probably having the opposite effect to the one that he would want by constantly lambasting the Fed. Again, in that respect, the Fed is showing its independence. The bigger question about to what extent lots of disagreement and dissent is good or bad, I don't have a good answer. The obvious candidate for the most disagreeing and dissenting central bank is the Bank of England, and it hasn't led to good decisions, in my opinion. So I don't think pretending that there is a consensus when there isn't, ECB, is good. I don't think openly disagreeing and having completely different views about how the economy works is good. Something in the middle, I think, is probably the better of those worlds. And the Fed, I think, in that respect, probably scores highest out of the G3 central
bank do you think has the most credibility right now? And which one has the least?
I'm thinking hard because who I believe has the most credibility and who everyone else does probably is slightly different answers. Hey, look, ultimately, I think all of the major central banks are deemed to be credible. I don't think truly anybody has good justification for believing that there is a lack of inflation sort of fighting credibility. There's definitely less because inflation has been elevated for such a sort of extended period. Again, my personal view is that the way these inflation mandates are written and implemented is a terrible idea. Inflation is an impossibly complicated subject that economics has no good model for. There is no good model for the inflationary process. And therefore, the understanding we have is a series of partial understandings, interaction of macro and microeconomics in a way which doesn't make it easy. So the idea that central banks can be really sensitive to 0.2 of a miss here and 0.2 of a miss there is utter nonsense. So I think the Antipodeans handle this better because they have a range. So the RBA and the RBNZ have inflation within a 1 to 3 range. I think that's a much better way of preventing all this criticism of you're at 2.2 when you should be 2. You know, if you look in the post-crisis period, inflation was kind of 1.7 and people were running around with their hair on fire and central banks were buying assets like they're going out of fashion. In my opinion, that is the height of madness. You know, I would point you to the last chapter of Paul Volcker's autobiography where he sort of systematically destroys this way of sort of treating inflation mandates. 2% is not a magical number. There is no empirical evidence and there is no academic evidence for why that is the right number versus 3, 1 or 0. Stable prices, yes, we can all agree that's a good idea. Specifically 2%, and indeed CPI, which in my opinion is not inflation. And again, this is something that Kevin Walsh has talked about. That's why he was looking at trimmed mean and why he was looking at marginal price changes, because inflation, as properly defined, is a general rise in the level of prices. If you take all of the prices in the economy, which are all responding to all sorts of macro, micro, global and domestic conditions, and they're all going up and down all over the show, and you just average them out, that is at best a proxy for inflation. It is not inflation. And so I think all of that, the way in which those policies have been handled, the way in which those mandates are implemented is terrible. I guess ultimately when push comes to shove, the Fed is still considered the most credible of the central banks, even though there is significant questioning of its independence in this current moment. I think very few investors truly believe that the Fed would sacrifice its inflation mandate. I think there is a belief amongst some investors that all central banks are to some degree have a soft approach to inflation because it's one way out of the debt problem that we've created for ourselves. I think that nuanced argument probably has some credibility to it, whether it's consciously or unconsciously on the part of the central bank. What I would say is that it's difficult to separate the institution from the individual. And when you're a central banker, there's two errors you can make. You can be too hawkish or you can be too dovish. If you're too dovish, equities go up, asset prices go up, the economy booms. In the here and now, nobody complains that you're too dovish. By the time you've retired, you walk away a hero. The problems come way down the line. If you're too hawkish, everything goes wrong now, instantly, and it's your fault. So there is a natural personal inclination towards erring on the side of dovishness because that error feels less painful. It takes a long time and you probably won't be blamed. I personally think Alan Greenspan carries a lot of responsibility for the NASDAQ bubble and for the global financial crisis, but he never really was criticized that heavily, not least until really we got to 2008-9. Whereas when Jean-Claude Trichet hiked rates in July 2008 and did so again in 2010, he was lambasted as an idiot because it was obvious very quickly that he'd made a catastrophic error. So which error would you choose to make if you were an individual within the institution? You would shoot for the dovish error because it's the less obvious and the less the one that you're going to be less sort of publicly lambasted for. So I think that's why central banks have tended to have this asymmetric dovish.
Sort of answered this, but just because you brought the RBA, recently raised their interest rates by 25 bips. I don't understand how is that going to affect inflation when it's purely driven by supply side?
Well, so the thing with the RBA, we'll give them some credit here. They were hiking rates anyway. So they were on a path of rate hiking before the Iran situation kicked off. I think to understand the RBA's policy today, you have to go back to the RBA's policy of yesterday. The reality is they hiked rates by less than everyone in the aftermath of COVID. So I think if an error has been made by the RBA, it's that they weren't hawkish enough to start with after the COVID and Russia-driven inflation. And what that's meant is that they had some sort of latent inflationary pressures in the system that never went away. And so as they started to actually show increasing inflation pressure again, the RBA under new governorship said, we can't allow this to go on. We have the potential of an inflation problem here. We need to make an adjustment to monetary policy to go from probably slightly easy to slightly tight. They were on that path anyway. So then when they get a shock, which is inflationary, it's much easier to say, well, this has shifted the risks even further. So we definitely need to hike. So they've hiked 3 times in a row. They're expected to probably hike once more. The market is priced for them to hike twice more. I think that's probably too much, twice more, particularly as the Australians have a sort of housing market like the UK. They love to buy houses and speculate on houses. And that's a significant vulnerability because like the UK, they have floating rate or shorter dated fixed rate mortgages. So there is, real rapid transmission into the housing sector, into the consumer from increasing interest rates. So I think probably one more hike from the RBA, but the reality is it's not purely about Iran. Actually, they felt they had an inflation problem.
That makes sense. From Bloomberg in April last year, and you said that the Feds could go from not buying treasuries to doing it in size. And I'm quoting you directly, in the blink of an eye. What specific sequence of events that could trigger that? And if that happens, does it signal about the US as a sovereign borrower?
Well, I mean, not in size, but the Fed has gone from selling to buying, right? So it's, we get into the technicals of the US monetary system, and we could talk about this for hours, and it gets needlessly complicated. But ultimately, the US runs what they call this ample reserves system. So that where previously they would have made banks compete for the reserves they needed, now there's more reserves than everybody needs. There's lots of reasons for that. We won't go into it. But nobody knows where the line between excess reserves, i.e. there's just the system is awash with liquidity, and ample reserves and scarce reserves is. Nobody knows. The Fed doesn't know. And so what they do is they unwind the balance sheet until they start to see tension in money markets. And once they start to see tension in money markets, they think, okay, we've gone too far. And that's basically what happened. Now, that's what happened in 2018-19. That's back when Jerome Powell was fairly new as the chairman of the Federal Reserve. And he had very different views about monetary policy then, views that I could subscribe to. I cannot any longer. He thought R-star was a terrible idea for guiding policy because it's unobservable, and he really wanted to shrink the balance sheet, funnily enough, in the way that Kevin Walsh does today. And so he uttered those immortal words: the Fed's balance sheet unwind is on autopilot in late 2018. Equity market had an absolute swan dive. We had the Christmas Eve massacre, massive decline in equities. And suddenly, because markets reacted badly, the Fed was in a different place. Its last hike was in 2018. And before you knew it, it was cutting rates in 2019. But also, it created problems in the repo market. And the repo market is so utterly crucial to US funding markets that a problem in the repo market can really manifest negatively across banks, across the financial system, and ultimately the economy. So all of that combined told the Fed they'd taken too much liquidity out, and so they started putting liquidity back in. So they cut rates and they started QE again. And that's basically, in a small sense, what we saw earlier this year, where the Fed went from shrinking its balance sheet to, over the last 6 weeks, its balance sheet has been rising again because it's been buying assets. So there are technical things to do with liquidity that can make the Fed buy assets. There is a potential world in which the Treasury bond basis trade blows up. This is, again, something that drifts in and out of the news at times, but essentially hedge funds, lots of asset managers like to use futures because they're cheap and efficient and liquid. So if I want to be long 10-year Treasuries and I don't have the cash, I can buy Treasury bond future, implement my trade that way. Lots of asset managers do that. So actually that means that futures look rich when compared to the underlying cash bond. There's excess demand for futures because asset managers like using them. So the future gets rich to the cash bond. The hedge fund says, I think that spread, that basis should be wider. It takes the other side. So the hedge funds ends up very short futures and very long cash treasuries. Now, if something happened which forced them to unwind that trade, suddenly they are forced to sell a lot of cash treasuries. So you could get a massive dislocation in the treasury market. If you go back and look at a chart of 10-year yields in the US in March 2020, you see that during the peak of the fear about this global pandemic, treasury yields shot higher because this was happening. Hedge funds were being forced out of positions where they were long US treasuries and they were forced sellers. If that were to happen, the Fed could easily and probably would easily step in, buy bonds to calm markets down. That's exactly what the Bank of England did in 2022. The Bank of England was selling UK gilts because its monetary policy needed to be tightened. And for a week or two, it was also buying gilts to try and calm the long end after the fiscal fallout. So central banks have shown that they are very willing to intervene in markets. They have no tolerance for dysfunction and dislocation. And here you go. Here's the problem. And this is why I call the Fed arsonist and fireman. The reason that some of these vulnerabilities exist is because there's too much liquidity, which allows too much leverage. So the Fed injects liquidity, suppresses volatility. Leveraged investors like hedge funds say, well, these conditions are incredibly stable. Leverage is cheap. So I'm going to do a lot of these not very lucrative trades that when leveraged up 10, 15, 20 times can be quite lucrative. So the Fed creates conditions which make leverage attractive. Then when that leverage leads to dislocations, the Fed's solution is to just do more of the same.
It's basically the implicit backstop that the Feds have created that's resulting in a very risky basis trade environment. And
basically, yes, there are vulnerabilities in markets which stem ultimately from central banks having policy too easy for too long. And the solution when those trades go wrong is for central banks to provide more of the very same liquidity which created the vulnerability in the first place. But each time the intervention gets bigger. The intervention from the Federal Reserve in the aftermath of COVID dwarfed what we saw after the financial crisis, even though the decision to shut economies globally was a conscious and intentional one by governments, which could be, averted very quickly. Whereas in 2008, you had the near end of the financial system as we know it. The magnitude of existential risk in 2008 dwarfed that in 2020, but the size of the response from the Federal Reserve was gigantic in 2020 relative to 2008. So what's the size of the response next time? I imagine bigger again. And this is the problem. It's like a power law where each one of these Federal Reserve or central bank liquidity cycles gets
I come back to a question I asked previously. How is this sustainable?
Ultimately, it's not. In my opinion, this is not sustainable. I think we're on an incredibly unsustainable path. You know, the interaction of central bank policy, the role that debt plays in driving the economy forward, structural issues like demographic shifts and decline, structural issues like sort of geopolitical instability, all of these lead to a financial system which, in my opinion, is prone to huge boom and bust, but the periodicity of that cycle is got so long that you can have people whose virtually their entire career goes on during the good times, so they've got no experience of what happens when it goes wrong, which leads to even more irresponsible behavior. You know, if you go back 100 years, an economic cycle was 5 years, and now they're sort of 12 years and they're becoming 14 years, which means somebody starts work, they work for 13 years and they've never seen anything but the good times. Their behavior is going to be a function of the environment that they grew up in, and it's going to be very pro-cyclical. It's going to underprice risk in very sort of Nicholas Nassim Taleb way. They are not going to believe that something can happen that they've never seen happen. The black swan risk is incredibly prevalent, and it leads to all sorts of moral hazards as well, all sorts of malincentives and poor behaviors. So ultimately, no, I don't think it is sustainable. It's just, as an investor, the potential time horizons involved are long and unknowable. So you just have to be kind of cautious about, you know, constantly positioning for the end of the world. It's something to be aware of, to keep your eyes out for signs of, but it cannot be the be all and end all of your investment style or your investment philosophy or your investment decisions.
My generation's going to be the one that's going to see prolonged uncertainty.
It looks that way right now. I mean, what sort of historians would tell you, economic historians would tell you, is that the aberration was the sort of peace dividend great moderation era. So if we take 2000, because let's go earlier, let's go to 1990. So if you go from 1990 to 2020, broadly speaking, in geopolitical terms, there was a lot of stability and a lack of war, certainly between major powers. Throughout history, that's the bit that's unusual. That was not the normal. That was the exception. But of course, we who grew up in that period knew only that environment. And so we have been programmed to believe that that is normal, when in fact, over a longer, sort of more relevant historical time horizon, that's the aberration. So in a sense, historians would say we are going back into a more normal environment. And yes, that does look more sort of turbulent in geopolitical terms. What impact that has on investing, though, I still think is highly uncertain. It's still not clear to me that that is good or bad for equities or risk assets, good or bad for government bonds. It really is. It depends, and it's just additional risk that you should demand compensation for at certain times when you're making investment decisions. Again, something that a lot of investors are not good at. They don't price risk appropriately. They just ride momentum and extrapolate the past into the future, which is very successful as an investment strategy right up until the time when it's catastrophic.
A recession is necessary, at
Yes.
this point of time.
Yes. Yes. It's the great failing of public policy is to believe that recessions are to be avoided at all costs. Recessions are a necessary part of the economic cycle, right? So I use this example all the time because it's perfect. So the Forestry Commission in the US in the kind of 50s and 60s got very adept at suppressing forest fires, particularly on the West Coast. Like, forest fires are bad. Fires are bad. They can burn houses down. They destroy woodland. We like woodland. We like nature. So we stop the fires. They stopped the fires and the forest died. Because the fire is a natural phenomenon that is a crucial part of the life cycle of the forest. It clears out the dead growth and the weak growth to allow new growth to emerge so that the forest constantly gets stronger. And what we're doing with economic management, constantly suppressing recessionary forces, is doing exactly the same. It's killing our economy. You go to a concept that was not coined by, but it's sort of made famous by Joseph Schumpeter, creative destruction. The misallocation of capital that occurs as you go through the cycle. Everybody's bullish, everybody misprices risk, and so every company can get access to capital. Some companies use it well, some companies use it terribly. And in a recession, you take capital from those that have used it terribly and make sure it stays with those that use it well, so that you're constantly giving capital to where it's most efficiently used, effectively used. That's capitalism. If you take away that creative destruction, then you just have a miasma of misallocation. Capitalism without default is like Catholicism without hell. And that's the world that we have created. So yes, we do need recessions. We do need recessions to remind everybody that risk and reward are two sides of the same coin, and to make sure that capital is allocated effectively and efficiently in the long.
So if a recession does come, can you walk me through what your fixed income playbook would be? Which sovereign bond markets do you position in first, and which ones do you avoid?
So obviously, quality and liquidity are the primary focus when you go from the bull market to the bear market, right? When you go from pro-growth to sort of recessionary conditions, you want to be reducing exposure significantly to the riskiest borrowers and the least liquid securities, and you want to be prioritizing exposure to the safest borrowers and the most liquidity. So obviously, historically speaking, US Treasuries are the best place to be. We talked about it earlier. There's maybe been some damage to that notion. When push comes to shove and things go awry, I would be shocked if Treasuries didn't turn out to be the best place to be still. So within a sort of a go anywhere, unconstrained global fixed income fund, I'm going to be doing a few things, not as a response to, but in anticipation of, because it's hard to trade in a lot of these markets once things have gone wrong. I want less corporate exposure, less high yield exposure, and I want more G3 or G10 government bond exposure in very simple terms. And I probably want more duration rather than less duration, because you're expecting that ultimately interest rates will be cut and forward growth expectations will fall. So you'll get a bull steepening of the yield curve, then you'll get a bull flattening of the yield curve. So I want to buy 5 to 10 year government bonds in the highest quality government.
Do you consider emerging markets in such a scenario, or is that something you want to stay away from?
Do you know what? It's a really interesting question. I'm bullish EM and have been for a while. I'm bullish EM because as I keep saying in public, if I want policy orthodoxy at the moment, I go to EM, not DM. Because actually, EM has never been afforded the sort of freedom to be as fiscally irresponsible as DM markets have been recently. So we've learned some bad behaviors in the developed world, and governments have taken advantage of it, and that's dangerous. Whereas in EM, you've tended to have, not always, of course, but predominantly, you've had much more orthodox policy and policy responses. And so from a purely sort of fundamental perspective, I still think there are great places to be in EM. The problem, the challenge, is that alone is not sufficient to be the driver of return on EM assets. If we get into a world where everything that's deemed to be risky is sold, I'm afraid EM clients, retail punters, institutions, people will sell their EM assets to some degree, and that selling flow will lead to underperformance of those EM assets. Selective exposures, possibly some short duration securities, but it's hard to believe that EM currencies wouldn't struggle as well, and so the currency effect is going to hurt you. So I'm likely to retain a core allocation to EM and accept that it will probably underperform when things go wrong. And I will use that to then build it up again. So use that weakness to build back into those positions that I see as being sort of lucrative. But I certainly would like to have less EM exposure as we go into a recession than I would have done during the sort of bulk of the cycle.
Underperformance is driven mostly by currency performance. And is that something you can hedge away?
It is, but obviously to the extent that it depends on the shape of the yield curve. So a really steep yield curve, because the hedging cost is dictated by short rates. So in a really steep yield curve, I can buy a 10-year emerging market bond, hedge away the currency, and I've still got some yield to pick up. Say, for example, cash rate is 3%, the 10-year yield is 10%. It will cost me 3% to hedge the currency, but we receive 10% on the yield on the 10 years. So there's still a carry advantage. So if yield curves were really steep, then I could hedge my currency and still have some yield left. But of course, I would still be exposed to the duration component. And it may well be that even if the economy is weakening, EM yields rise because of selling pressure, not because of a rational reassessment of the outlook of monetary policy, but just because people who were invested in EM markets sell, and that puts upward pressure on bond yields. So yes, there is a potential investment where you could hedge the currency. Yes, often a lot of the return from the EM local investing does come from the currency. So there's nuance, but broadly speaking, history would tell you that EM in general as an asset class is not going to do well in that initial period of going into a recession. Essentially, nothing risky will. The only thing that's going to work is duration and cash and maybe gold.
Follow up. You spoke
Sure.
about steepening curves, emerging markets. I'm sort of curious if retail participation keeps on increasing in, let's say, countries like India. Still think institutional investors could such an impact where you're discredited from investing in Indian government bonds?
Yeah, so each EM is a pretty broad brush. And so, of course, we talk about the asset class, but then EM investors often will say, hey, look, these are not the same economies. They're vastly different. And so, broadly speaking, you have some emerging market economies that are quite equity driven. The equity market is the main source of foreign, or the main destination, for foreign capital, and some that are more bond driven, where the bond market is, and some that are a bit of both. And then you have some where domestic participation dominates. Most of the bonds are held by domestic investors, and then you have some where the bulk of the investing is done by foreigners. Generally speaking, obviously, the larger the economy, the more likely that the bulk of investment is domestic in source. So there's nuance. So yes, you're absolutely right. In a market, and India might be an example of this, in a market where the domestics dominate the local bond market, you are much less sensitive to what the foreign capital is doing. Absolutely.
At the moment, I think retail participation is less than 10% in India, which would eventually increase as compared to 50% in the US.
Well, and it doesn't need to be retail, it just needs to be domestic. So if it's Indian institutions, Indian pension funds, Indian asset managers that own their domestic bond market, then clearly they are not, that's not hot money that's likely to sort of go home when things get rough. Like it's those kind of hot money capital flows that tends to be the problem for investing in EM. When things go awry, US investors bring their money home. Japanese investors bring their money home. Like, why is the Japanese yen such a powerful risk-off currency? It's basically that dynamic. Japanese interest rates have been zero for 30 years. Japanese equities have gone nowhere for 30 years. Japan saves a lot because it's a current account surplus country. It exports more than it imports, so it has high national saving. A lot of that goes into the domestic bond market, but a lot of it goes offshore and buys foreign assets. Now, when things go awry, that money comes home. You want to put it somewhere safe. You don't want to run a lot of risk, currency risk or equity risk. So you bring that money home and the Japanese yen appreciates. So the Japanese yen goes up when things go wrong, at least partly, if not predominantly, because Japanese investors bring their money home. Capital flight. And the same tends to be true of EM. People who are invested in EM from around the world, UK investors, US investors, etc., happy to own EM when things are good. When they get worried, when they're worried that we're going into recession, they'll just bring that money home without asking questions about the specifics of India or the specifics of Indonesia. They might own a fund. So they're not investing in India directly and specifically. They buy an EM fund and it happens to own some India. So if they sell their units in the fund, it's kind of irrelevant the specific situation that India is in. There is a asset allocation decision away from EM and India would be part of that. So you can be fundamentally right, but technically wrong in that situation. You do all of that assessment about the reality of India's specific dynamics. But if everybody's selling the asset class, that's not going to protect you. I think it's very similar to what we see in sort of BDCs and private credit at the moment. The private credit managers are there going, hey, hang on a second, we own this asset and it's good and we don't have so much software. And that's kind of irrelevant if the entire world just thinks you're all one asset class and it's all a reason to worry. They're just going to sell first and ask questions later.
Different is investing in local currency EM debt versus hard currency Eurobonds? Because I know a lot of people seem to treat them as the same thing when they're really not. So which one would you prefer and why?
So different ones at different times. So again, local currency markets, when you look at each individual market, that is about growth, inflation, monetary policy. That is the same conundrum that we are trying to solve when we look at the treasury market. And of course, as a foreign investor, the currency effect, which is, again, all connected to growth, inflation, interest rate differential. So that's a standard, what I would call rates investor toolkit. You're doing the same for each of those EM countries as you would do in the US. There's no difference. Hard currency investing is credit investing. That is about the willingness and ability of a country to pay debts in a currency that it doesn't print. So it's a credit risk. So that's a very different skill set, a very different toolkit. The fact of the matter is they're highly correlated, and they're highly correlated because to a significant degree, sentiment drives both and flow drives both. If you have a product which is kind of blended, does some hard and some local, again, flows into and out of the fund are going to affect both of those distinct asset classes. So there's fundamental drivers, and then there's just correlation because of how investors think about these things. Obviously, hard currency has always tended to be the bigger and more popular trade. It's tended to be more liquid, and there isn't that sort of inherent currency risk in people's minds. I think that's a bit of a misstatement. I think there is still currency risk. It's just kind of hidden because, again, if South Africa's exchange rate is declining meaningfully, then it's costing more and more rand to buy the dollars it needs to pay its dollar coupons, to pay down its dollar debt. So that is hurting its credit profile. So the FX does have an effect on the hard currency. So there's definite linkages between the two. Which one do I like? It sort of depends. Like right now we have both. We have exposure in both hard and local currency because generally we think spreads are tight. Credit spreads everywhere are too tight. So we don't want a lot of credit risk, but there are specific examples within the EM world where we think spreads are actually attractive and they're given as good value. Romania is one. Pemex, the Mexican petrol company, is another where spreads have been, we think, too wide given the specific situations that those issuers are in. Local, that's more about monetary easing, and right up until the war, we felt really comfortable and confident that a lot of these EM central banks, particularly in LATAM, were going to be cutting rates because they've got incredibly high real rates and it's kind of crushing their economies. Brazil is the obvious case, but Mexico, they cut rates again this week. So there's a potentially a powerful dynamic. Currency appreciation, because the dollar is unloved and has been quite weak, so their currencies are appreciating, which pushes down inflation pressures by imported disinflation. As they cut rates, the economy can grow. That attracts capital inflows, which pushes up asset prices. You have this potential virtuous circle. That really has been the core thesis for us in EM, and that's very much a local currency.
I think spreads are going to be changing when we're transitioning towards a more multipolar, multi-currency world.
I mean, spreads are still largely going to be a cyclical phenomenon in aggregate. They're going to be wide when you're in the middle of a recession or at the end of a recession, and risk taking is, people are not prepared to take risk. People are trying to be defensive. People are worried. People are concerned about growth and losses, essentially credit deterioration, and spreads are going to be tight at a moment like this where nobody believes there's any risk. We'll never have a recession, and tech is going to save the world and make it an unequivocally perennial growing machine. Specifically, how does kind of the uncertainty and volatility of policy and policy making and geopolitics and the sort of bipolar US-China world, how is that going to affect spreads? Wow, it's really hard to say, because I think we'd need to be more specific about what that world looks like, and we'd need to be specific about which spreads we're talking about. I think in the most basic sense, you probably end up with two spheres of influence: countries that are aligned to the US, countries that are aligned to China, and then you end up with the countries who are trapped in the middle, and India is definitely one of those, Australia is definitely one of those, South Korea is definitely one of those. These are countries that are sort of economically dependent on China to some degree, or economically integrated with China to some degree, but are sort of politically or security or geopolitically more inclined or more aligned to the US, and they have to try and play both sides. So Latin America may well end up being a kind of beneficiary of President Trump's current foreign policy. So maybe spreads can tighten in there. It's the likes of South Korea, they may end up having more volatile spreads because they sort of get trapped between the two and they get pushed and pulled in both directions. Africa, as always, is a completely different situation. And then sort of Central and Eastern Europe, as we can see today, a lot of their issues are more about economic management, but there are potentially sort of security concerns and defense issues around Russia and its behavior and its interaction with Europe as well. And again, that could push spreads wider if things go badly. That could lead to them being much tighter if the war in Russia and Ukraine were to be resolved. So hard to give a certain answer, but there's definitely the potential for influences in either direction.
2 quick follow-ups. I keep it short. do you see a world where a BRICS currency ever pops up? And then second, do you start preparing for it right now? Or is that something for the future?
You can never say never. So I couldn't say I can't see a world where a BRICS currency pops up. The decisions that politicians take never cease to amaze me. The extent to which politicians understand economics is quite concerning in general. The euro, I think, is a terrible idea, implemented terribly. And the commonality between the countries of Europe is far higher than the commonality between the countries in the BRICS. The notion that you have a common currency because it makes trade and transactions easier is a nice notion, but it's literally 1/100th of the problem. Having a common monetary policy across a region that does not satisfy any of the criteria of an optimal currency area. You speak different languages, there's no labour mobility between you, there's no fiscal transfers between you. Having one monetary policy across a region that big, that diverse geographically and in terms of population and culture would be an unmitigated disaster, in my opinion. There is nothing good to be said for BRICS currency, economically speaking. So I think it would be a catastrophic idea. Whether they would do it, and like I say, I don't think so, but I could never say never. Would I position for it in advance? No, absolutely not. If you look at the convergence trade, again, with respect to the Eurozone, it happened relatively late in the process and was wrong. The notion of convergence normalizing the risk between these countries was just false, utterly false. And if you bought Italian BTPs all the way down till they traded flat to buns and kept holding them, you got absolutely taken to the woodshed during the crisis and the Eurozone crisis. Because risk that should have been obvious to everyone if they were paying attention had been conveniently ignored because it was politically and financially expedient to do so.
I guess since we're reaching time, my last question is not about markets. It's about life. If you had to give one piece of advice, a way of thinking to someone who's trying to build a better understanding of macro and bond markets from scratch, what would it be?
Okay, so it's such a complicated topic. It's difficult to give one piece of advice. One thing I'd say personally is stay humble. This is an incredibly complicated topic and nobody knows much. Everything we do should always be couched in uncertainty and probability. And so being really humble about what you do know and don't know, I think is always an important skill to have. I think the single most important skill that one can learn when it comes to macro investing is learning what to ignore. Because at any given moment, you could conjure up 10 or 15 things that could potentially be powerful considerations for what might drive treasury yields higher or lower, the dollar higher or lower. But in reality, the market's attention span is not wide enough to consider all of them, and it's likely to focus on one or two. If you can identify those one or two, you will be ahead of the game. So learning, understanding, being sort of brutal about ignoring things and focusing on what matters. Easy to say, not easy to do, but if you can develop that skill set, you're already ahead of the pack.
Sense.
Always think independently. Question everything. Do not take anything as read. Read something and think, why might they be wrong? What assumptions has this person made? Do I agree with those assumptions? Do those assumptions make sense? Why? How did you get to this answer? Like, question everything. Do not take anybody's view at face value. Do not believe that they're more credible because they come from this university or that asset manager or that bank. Think critically. Think critically and think independent.
Makes sense. James, this has been brilliant. Thank you so much for your time.
My absolute pleasure, Krish. Thank you for having me on.